All right, let's talk about the chaos of the financial markets. It often feels like pure random noise, right? But what if I told you that hiding beneath all that static, there's a pattern, a rhythm we can actually use to predict the future? Today, we're going to learn how to tame that chaos.
So, here's the big question. Is it all just a random walk? When you look at the day-to-day jumps and drops of a stock, it's easy to think so. But it turns out that's not the whole story. Hidden inside all that apparent randomness are echoes of the past, clues that can tell us a surprising amount about the future.
You don't have to take my word for it, just look at the evidence. What you're seeing here are the daily returns for Google stock over a few years. As you scan across the timeline, something really interesting starts to pop out. You see these quiet, calm periods, and then bam! You get these bursts of wild activity, where huge up and down swings are all bunched together. Take a look around 2020, for instance. It's almost like the market has moods. Calm periods tend to be followed by more calm, and chaotic periods, well, they're followed by more chaos.
Now, this thing we're seeing, it's not just a fluke. It actually has a name, and it's one of the most fundamental concepts in finance: volatility clustering. This is our first huge clue that what happens in the market is not entirely random.
So what does that mean in simple terms? It means the market has a memory. When things get nervous and prices start swinging wildly, they tend to stay that way for a bit. And when the market is calm and quiet, it tends to stay calm. This is huge because it means that yesterday's turbulence gives us a real, measurable clue about what we might expect today.
Okay, so if there's a pattern, that means we should be able to create a model for it, right? To basically build a mathematical forecast for the market's weather. And that's exactly what some very smart economists and statisticians set out to do.
The first real breakthrough on this came back in 1982 from Robert Engel. He introduced a revolutionary idea called the GARCH model, and it was so important that he later won a Nobel Prize for it.
Now, the idea behind GARCH is actually pretty simple and intuitive. It basically says that tomorrow's volatility, which is really just a fancy word for how much prices are swinging, is directly related to the size of yesterday's shock. And a shock is just any price move that was bigger than we expected. So if we had a big surprise yesterday, the GARCH model predicts that the market's going to be a bit more on edge today. But, of course, there was a catch. To really capture that long memory of volatility we see in the real world, these GARCH models needed to look back at a lot of previous days. This made them really clunky and inefficient to work with. There had to be a more elegant way.
And there was. Just a few years later, one of Engel's students, Tim Ballerslev, came up with a brilliant extension. He generalized the GARCH model into what we now call the GARCH model. And this was the powerful, elegant solution everyone was hoping for.
This slide really shows you the leap forward. You see, GARCH only cared about yesterday's big news, that recent shock. But GARCH does something much cleverer. It looks at yesterday's news, and it looks at what we thought yesterday's volatility was going to be. It basically adds a memory of the overall volatility level itself, not just the latest surprise. Let's peek under the hood for a second. This is the classic GARCH 1-1 model. That alpha term? That's the old ARCH part, reacting to yesterday's shock. But the real game changer is that beta term. That's the GARCH innovation. It's the part that looks at yesterday's volatility forecast. Just adding that one extra piece gives the model a much richer, longer memory in a super efficient way. Now, for anyone who's worked with time series data before, this might feel familiar. The jump from ARCH to GARCH is a lot like upgrading from a simple AR model to a more sophisticated ARMA model. In plain English, you're just giving the model a much more nuanced and powerful way to remember the past. Okay, that's enough theory. Theory is great, but let's see how this thing actually performs in the real world. We're going to go back to our Google stock data and see if we can build a GARCH model that actually works. So, first things first, how do we even know that GARCH is the right tool for the job? Well, look at these charts. The top ones showed that today's price return isn't really predictable from yesterday's. But the bottom charts, now that's where it gets interesting. Here we're looking at the squared returns, which is just a simple trick to measure the size of the move. It's volatility. See all those bars sticking way out? That shows strong autocorrelation. It means yesterday's volatility is a really strong predictor of today's. That is the statistical fingerprint of volatility clustering, and it's a giant green light telling us to use a GARCH model.
Okay, so we go ahead and we fit our first GARCH model. We start by assuming that the price shocks follow a nice, standard bell curve, a normal distribution. But when we check the results, look at the diagnostic plot on the bottom right. That's called a QQ plot. See how those blue dots peel away from the red line at the top and bottom? That's our model telling us it's struggling. It's not capturing the really big, extreme price swings. The real world has fatter tails than our simple model thinks.
But here's the beautiful part. This is an easy fix. All we have to do is make one tiny tweak. We just tell the model to use a different assumption, a student's t distribution, which is specifically designed to handle these fat tails. And just like that, look at the new QQ plot. The dots are hugging that red line almost perfectly. We now have a model that captures the reality of the market much, much better.
And now that we have a model we can actually trust, we can do what we set out to do from the very beginning. We can forecast. This chart shows the model's 20-day forecast for Google's volatility. That orange cone shows the range of likely outcomes. We've officially managed to predict, to tame, some of that chaos.
Okay, so this is a really cool statistical exercise. But why does it matter so much? I mean, why did this whole idea win a Nobel Prize? Well, it's because being able to forecast volatility isn't just neat. It's absolutely critical to how modern finance works.
GARCH models are the engine running under the hood of so many crucial financial tools. Banks use them to calculate their value at risk, basically the most they think they can lose on any given day. Traders use them to figure out the fair price for options, since an option's value is directly tied to future volatility. And big-time portfolio managers use these forecasts to decide when to be aggressive and when to play it safe. It is a fundamental tool for anyone trying to navigate the markets.
So GARCH gives us this incredible power to find the hidden rhythm in the noise, to predict risk based on the patterns of the past. It's an amazing tool, but it does leave us with one last really deep question to think about. A model that's trained on history is great, but how can it ever truly prepare us for a future that looks nothing like the past, for a shock that is completely, totally new? And that, well, that's something for all of us to ponder.